Yep. And I'm going to be showing you some of those FAQs. I know that some of you might have to jump off, but for the rest of you, well, I'll continue throwing some slides up while we answer questions.
Okay, there's the kit page. And I'm also going to post the link to, now, we would love for you to ask questions in the Q&A, not the chat. It's really hard to keep track of questions in the chat because the chat kind of flies by. So please, please, please post your questions in the Q&A. Okay, just adding this link here. We have a bunch of questions going. Lots of people talking about their locations and their temperatures first. Okay, let's see. You say your previous investments have actually overperformed with great results. Do you think this will continue in today's environment?
No, I think that the returns that we are so proudly showing you were impacted by a one-time extraordinary increase in prices and a one-time extraordinary decrease in cap rates that cannot be replicated. So what I would hesitate to say is, well, yeah, you know, we're projecting that we'll give you 16 IRR and we can do 32. I don't think anyone can do that. I think that the honest answer is, I believe that we can hit our returns, and I think we can overperform if the market bounces back, not to the 2022 madness levels. I don't think that's ever going to happen. But if it goes back to the 2019 level, which was a more normalized year with normalized interest rates, I believe that we can outperform these numbers.
Let's see. Is there no difference in the return? This is the investor's return, whether you invest in directly in the asset versus invest via the fund?
There would be. Keep in mind that the fund has 3 properties, and each of those properties is going to perform slightly differently. So I'm going to find a slide that basically shows you what we are projecting in terms of the fund's returns. And here you can see the fund's targeted returns. Right now that the fund, you know, all 3 assets have been targeted, we have a better sense of this. And I think that these numbers are pretty valid. We didn't think that we would get to a high cash flow asset like Midtown Ridge. So the funds always have a range. A single asset tends to be pretty sharp on the range. You pick a number and you say, okay, this is what I think I'm going to get to. With a fund, because you have multiple assets, you have a range. So if you're investing into the fund, the IRR, AAR, cash on cash, and equity multiples are shown here. I do think that by now I have a sense that the equity multiple is closer to that 1.9x than the 1.5x. We didn't know this when we were creating the fund, so we wanted to give ourselves a big range. So a lot of these numbers, I think, are likely to be on the higher side than on the lower side. But a fund does not have numbers as tight as an individual asset does. So no, your returns would be slightly different from investing into this asset versus investing into the funds. And there's obviously a value for diversification.
Is 6.8% cap rate tax adjusted and insurance adjusted?
I don't know the answer to that. So I believe it is.
The answer is yes, it is.
Because I think we were in the 7s when we hadn't adjusted it.
No, it is. That's the cap rate and tax insurance adjusted. So I'll answer that one for you, Neal. Yeah, the answer is yes.
Yep.
When do you plan to close and when do you need investor funds by? I will take that one. So if you're not doing a 1031, we are planning to close by April, but that doesn't mean we don't need your money till April. Anyone that's coming into the fund, sign your docs, and once it's accepted and you pass the accreditation, that's when your money is due. It is a first come, first serve situation. When you sign docs, we don't hold your spot. So, sign docs and come on in is what I would say. Yep.
And keep in mind that we're not just opening this up to our investor community. It's likely that we'll open it up to other investor communities out there. And those communities usually give us $1 million checks, right? So we'd like to give priority to our teams, but we also have other relationships outside of our investor base. So I think that another way of saying this is we're likely to close in April. We might close in March. So maybe it's March, maybe it's April. So the money that comes in, there's
Yes,
no
it could be
return
March.
for your money until the time when that the property is purchased. Now, if you're investing into the fund, obviously your clock starts ticking sooner because the fund already owns two properties.
So when is the seller, why is the seller selling at a big discount? Is a rate cap expiring? Do we know?
We don't believe the rate cap is expiring because this property has a fixed loan. So that could not be the reason. A rate cap is only used if you have a floating loan. This is a fixed loan, so it certainly wasn't expiring. This particular seller is extremely rich and has a large number of properties. And basically, each property has a life cycle, if you want to call it that. And he's divesting some portion of his portfolio. I think that, investors who have one property, they think one way. Investors that have 20 properties think a different way. They're always buying and they're always selling.
How do you estimate absorption rate?
We don't estimate absorption rates. We don't have the capability of doing that. Absorption rate is usually estimated by companies who take their data from, source companies like CoStar or um, Yardi Matrix. So CoStar has 50 Prius cars that are driving around the United States, and every time they see a construction site, they go in there and figure out when that site will deliver. Then they total up all of those, and that is your incoming supply, right? Then they calculate how many units the market is absorbing based on its growth rates, how many how many households are being created, what are the income levels and the inward migration. So they calculate all of those and they come up with an absorption number. And then they share those numbers with in their forecasts, and that's what we're using. We do not calculate absorption numbers.
Can you speak to a fixed 5-year IO loan given anticipated rate drops? Are you precluded from refinancing? Either way, the fixed and known loan payments with 79% LTV helps underwriting and thus cash flow projections, correct?
It is. So one of the nice things is the fact that this loan is fixed for the next 5 years makes it much easier for us to project cash flow, right? If it
Yes.
wasn't fixed, it was floating, then obviously that job is a lot harder. Now, today, let's say that it didn't have an assumable loan and we were going out into the market and trying to get a loan, we'd be around 6.3%, maybe 6.2, something like that, right? So we would already be 100 basis points higher than the property. Now, let's say that the Federal Reserve drops interest rates by 100 basis points. So 1 year from today, 1 year into our ownership, the rate would be where we are. So obviously it would make no sense to refinance then. Well, then the rate might continue going down, probably will. And let's say it ends up at 4.3% in 2 years. And that's probably where it'll stop. Now, that 100 basis point difference is probably not enough to refinance because we'd have to pay a penalty to refinance. But let's say it, for whatever reason, something like COVID occurs and it drops to 3.3%. Then we can basically say, does it make sense for us? The rates dropped by 200 basis points. Should we go in and refinance and basically just pay a penalty? So it's nuanced. Are there high chances that we'll refinance during the next 5 years? No, they're low. Are they zero? Certainly not. It really depends on how much the rate drops and when.
Sorry, Neal. The chances that we refinance are low to nil because we have a fixed 5-year loan with yield maintenance with Fannie Mae.
Right, right.
That's
The
our
example I was offering.
Yes, okay. So in your example, you were talking about a fictional example if we had a variable rate loan, right?
Well, no, I think no. What I was saying is, with any loan, you can refinance it, but you pay a penalty, and that penalty is pretty large. Now, each year, as the time goes on, that penalty decreases. So for the next 2 years, the chances that we refinance are nil. After that, if rates drop to 3%, it may make sense to pay that penalty, right? But what's likely to happen is if there is a refinance and the property is doing really well, we probably might refinance 3 years from now. Because in the first 2, maybe even 3 years, the loan defeasance penalty that we have to pay when we refinance is too high. It wouldn't make sense.
Okay, so this person has a series of questions, which I will answer, give them an answer at the end. This person says, I believe your business case for Chattanooga and the assets. Can we talk about the deal specifics and deal economics? What is the year-over-year rent growth assumptions you're building into the property? What other value add assumptions? What is the fee structure? What are the property management expenses and asset management expenses layered onto the revenues? Well, my friend, all of those questions and more are answered if you watch the 40-minute video walkthrough with Pete Levine and myself. It's available on the link that we put into the chat, that growcapitalist.com/MTR-kit. You can put it on your video immediately after you leave here, wake up to it in the morning. It's a very, very thorough walkthrough of the Excel spreadsheet and a talking through of all of those questions that you just asked. So we welcome you all to watch that. And if you have any questions, please meet with Peter Majeski, and he can take it from there.
Yeah, and you know, we love it when people ask that question. We love it when you go through that 40-minute video. But we know that there's a lot of investors that don't want to do that. They simply want to listen to the basics. But yeah, for those of you that want to dive deep, please go in there. You'll find that the assumptions are quite reasonable.
Yes. How are the other two investments in the fund coming along? Are they meeting, beating, or lagging the pro forma?
Anna, your thoughts?
Well, I would say that one of the assets had a little bit of a slow start. That's Park Avenue Villas, and our other asset, Monarch Villas, has 99% occupancy and had a challenge with the city that it is now in the process of overcoming. So I think 2024 is going to be a very good year for both assets,
Yes,
although they
I
both
believe so.
had a little bit of a bump. So I think, you know, definitely we're looking at distributions in 2024, and things are looking very bright. I think all three assets are excellent acquisitions, but you know, sometimes it can take 6 to 9 months for a project to really get off its feet, especially when you have
Yes.
unknowns like the city of Sandy Springs coming down on all multifamily in the area.
All multifamilies in the area. So that increased our expenses there, but that property has outperformed our occupancy, both economic occupancy and physical occupancy since every single month of ownership.
Yes, and you know, the story that we're telling you, you're welcome to look at every project that we have. There is, including Grow Fund, you get a monthly investor update. So the full story, you know, you can look at the investor update and go back and read every investor update and watch every webinar to get all of the details of what's been going on. So definitely something you may want to do so that you have all of the details. Let's see. Does the return include all the fees?
All of the fees are included in the returns. These are returns net of any fees. They're also net of our profit splits. So our profit and our fees are removed.
Can it be IRA or 401k funds?
Yes, actually, we didn't say that, but it's eligible for self-directed IRA funds, also eligible for solo 401k funds. Actually, that's on the screen. Yay!
Yeah, is the cash on cash being distributed monthly? No, Hugo, we distribute quarterly.
Yes, we're a small team, and monthly distributions just impact the team's performance too much, so we do quarterly distributions.
Here's a great question. Is the tax treatment any different if you're investing in a fund versus directly into the property?
Well, not necessarily. You're essentially, you know, let's talk about depreciation. You're getting depreciation from 3 properties, and it's being spread out across. The fundamentals of tax, you know, avoidance do not change whether you're buying 1 property or 3.
I'm trying to understand why the value decreased so much from the August appraisal.
Honest answer is this, that at this point, the interest rates are high. So right there, 6.3%. So when people are looking to buy the property, they're going to set the value based on the interest that they have to pay. Now, we're not paying that. We're at 5.3%. So obviously there's a big gap there. So the bank looked at that and said, yeah, you know, it's a 5.3% loan. We know how much interest is being paid, and we're going to assess it accordingly, which is fair. But today, the vast majority of buyers, they don't have access to assumable loans. A lot of loans are not assumable, or maybe they're getting over in the next year, so it doesn't make sense to assume them. And so those buyers are looking at the market and saying, hey, I probably have to pay 6.3, 6.4% interest. And, you know, until the Fed starts cutting, which is 4 or 5 months from now, these rates could still go up. And so they're doing their underwriting on that basis, and they're willing to pay on that basis. And so that's why the huge difference.
Let's see. Many projects are withholding cash flow in the current market. With this project, will this project have a quarterly payout?
Well, we feel comfortable, we feel confident about that for two reasons. Most of the projects that are withholding cash flow, they've suspended cash flow. We've seen that happen. I would tell you probably 90% of those were floating rate loans. And when those rates floated up and up and up and up, either, the basically a lot of the cash flow went towards paying the mortgage or went towards paying for expensive rate caps, $1 million, $1.5 million rate caps. We have a fixed loan for the next 5 years. There is no rate cap. So while I would say that the biggest single reason that the vast majority of properties that have stopped payments, including ours, by the way, some of our properties have also stopped distributions for these reasons, is variable loans.
Let's see. I'm not quite sure where this one comes from. Why was the pro forma occupancy for Chattanooga down in first quarter 2026? Orange line. I think you have to go back to.
Sure. I will take a look. So we'll go back to that particular slide, but keep going with the questions while I find the slide.
For fund investors, is their investment split into 3 equal parts for each property?
No, because some properties are more expensive than the others. For example, this property is double the price of Park Avenue Villas, so it would have double the impact. So
Yeah,
I would say
so more of your
probably
money
a
would be
40%
invested in this
impact would be in
property.
this
Yeah.
property. Yeah.
Yeah. The exit cap rate is a question. There actually is, so the exit cap rate is 5.25%. It is in the underwriting video.
Yes. So it's and reasons for picking that are we've discussed all of these reasons amongst ourselves. We feel like that number makes sense.
Would this property require the full value add to perform as anticipated, or as part of its success simple appreciation? No, we don't rely on simple appreciation. The property would require the value add that we have identified, which again is taking 79 classic units to a partially renovated state. Thus, for a 1986 property, you would have effectively 100 partially renovated units. And I have to say, the renovations by the current owner, they're not so good looking. I couldn't tell the difference between the classic units and the partially renovated units myself. So there is a lot of meat left on the bone. Our 79 will look better than their 79 partially renovated, but none of the units will have been taken to a full renovation, which is, considered to be granite, stainless steel, et cetera. So there is a lot of opportunity for the next owner to come in, and our business plan is only 79 classic units taken a partial renovation.
And I'm ready to answer that question. The reason why there is a sharp decline in projected occupancy, the blue line, in Q1 2026 is it's very likely that there is a major project, let's call it 400 units, that is projected to deliver right about here. So when that 400 units delivers, it tends to drag down the rents in that marketplace at that point of time. And when it drags down the rent, occupancy drops because all of a sudden those tenants are getting redistributed because all these 400 units are getting delivered. So as those units get delivered, if the market absorbs them, and this market is absorbing them over these 3 quarters, this one, and this one, then occupancy over time returns back up.
Let's see. So we have a couple of people asking, when will the quarterly distribution start? So it's actually in the FAQs, Neal. Basically, the quarterly distributions, it always takes us at least a quarter to stabilize the property because there's a lot of ups and downs, bills coming in from utilities and all kinds of stuff that's a little crazy the first 3 months in terms of billing. So we need it to even out. And so we're anticipating distributing the after the first full quarter of ownership. And then the secondary, sorry, Neal, I don't know exactly what.
Well, I don't know where it is because there's so many FAQs.
Yeah, I know there's so many FAQs in here. Anyway, that is after the first full quarter of ownership. And then when do we anticipate the fund will start distributing? I would anticipate the same timeline at this point that we would
Yep.
start distributing in the same timeline. Have you visited the property? Why, yes, we have. Our
Yes.
you saw the video. That was our director of acquisitions and development on site, Pete Levine. In fact, tomorrow our director of asset management will be on property on site, meeting with our property management for 2 days. So this is our due diligence period, and we are on site and doing a lot of work there right now. Let's see, when was the property built? It was built in 1986. Has the growth fund stopped any cash flow distributions on the other two investments? So it did not stop.
Yeah, right. Yeah, we haven't started yet, but the key thing is you should know that a fund doesn't distribute, by property. There would be one distribution to you when you're investing in the fund, and that would be from profits gathered over the three assets. So you might have one asset that's underperforming and one that's overperforming. That sort of makes up, and that's why people like the idea of investing through a fund rather than investing into an individual property. But we haven't started yet.
Let's see. So this property will be co-owned by both the fund and direct investors. How much of the fund's money goes into this property, or what will the fund's ownership be of this property?
Well, that depends on how many of you choose to invest through the fund versus how many of you choose to invest individually. In the end, it really doesn't matter. Think of the fund as one big investor, right? So instead of investing 125,000, that big investor is putting $2 million or $3 million into the property, and the rest of the investors are investing $100,000. That's the way to look at it.
Yeah. Are the returns lower if I invest as a 1031 into this property?
No difference at all.
No difference. I'm not sure what this means. Can you guys take the foundation money?
Don't know what that means.
Okay. I currently invested 75K into the growth fund. Can I add another 25K to my investment now? The answer is yes. Sure. We'd be happy to do that. And when we put out our last property, Park Avenue Villas, we had a lot of investors do that as well. Let's see. I've already invested in the fund during the first two investments. Can I invest directly in the third property independent of the fund? Sure.
Of course. Yeah. No issues.
Yeah. Now, we did have another question related to this that was said, when you launched the fund, you said it would be the only way to invest in value-add projects. What changed?
What changed is that we have investors that still like investing into individual properties. I believe that investing into the fund is the best way. I told you that then. I'm telling you that now. But many investors want to invest individually. And it's not for us to decide how people should invest.
I would just add on to that this property, because of the timing of a property we just exited, and we are taking a 1031 group with us, and this was by far the best asset that we could present to them. So we have a group that are 1031ing into it. A 1031 can't go into a fund. They have to go directly into a property. So we had to allow, in this case, direct investment into this asset. And so once we had to enable that, we opened it so that people could do that directly as well. Let's see. Who gets liquidation preference? How many share classes are there? What are the specifics? Maybe you could go back to the class structure.
Right. So let's say we're selling one of the three properties in the fund. Nobody gets any preference. It's being divided. So let's say on the B1 side, these guys have 5 million. On the Class C side, these guys have 1 million. Well, these guys would get, let's say there's, $60 of returns. These guys would get 50. These guys would get 10. So it's a share of, what the investment that they've made. So they're all next to each other. Nobody's ahead of anyone else.
Why would you get a fixed rate loan in an environment of declining rates?
For one simple reason, if we wait until rates go down. So let's say we wait for 1 year. Well, the projections are, rates will decline by 100 basis points. So if today they're at 6.3, then in 1 year they'll be at 5.3, right? So now we miss out on that 1 year. But when rates go down from 6.3 to 5.3, don't you think the values might go up? Because the only reason that multifamily prices have declined, demand is extremely high. The reason they've declined is because rates are high. So a year from now, we're still at 5.3, but we may not get this price. Now, 2 years from now, they may be at 4.3. Well, now the prices might be much higher. Wouldn't you want to buy today at today's depressed prices so that 2 years from now, you basically banked millions of dollars as prices go up, as rates go down? Rates have gone down, rates have gone up, prices have gone down. Rates will go down, prices will go up. So it makes sense to buy now, right? Not a year or 2 years from now. I'm not saying it may be a bad time to buy 2 years from now, but today is actually a terrific window.
Let's see. What happens to the invested money prior to deployment?
We do not provide returns prior to deployment. Basically, we're collecting money and we're waiting to close on the property. Remember, the bank needs to see about $8 million in our bank before we can close. So that's part of the investment process, but your clock starts to tick when you've invested into the property, when the property is purchased. If you invest in the fund, then your clock starts ticking immediately.
Was there ever a capital call by growth capitalists?
Yes, we've had 31 projects. We've had one small capital call, and that capital call was $1.5 million. Investors had invested $5 million. We put in 40% of the money for the call. So far, the investors have put in about $500,000. So that was for an asset that's a new construction asset. So we've never done a capital call or even really contemplated a capital call for a value-added existing asset. So for that particular asset, as you can imagine, construction loans went all the way up to 11% as rates floated up. And so we needed extra money to finish the property.
Let's see, when do you anticipate selling each of the 3 properties in the fund?
Well, at roughly the 5-year point. So, for the first property, we bought it 13 months ago. So about 4 years from now. For the second property, about 4.5 years from now. For this property, about 5 years from now. So your money might be in the fund a little less than 5 years, because if you average it out, that's about 4.5 years.
Why do sellers seem to be selling only partially renovated rather than completing? Or why would a growth capitalist only have a few premium units to demonstrate to next buyer to increase IRR?
Well, for the same reason that we believe we can sell to someone else 5 years from now, you leave some meat on the bone. This seller is leaving meat on the bone for us, right? Because it takes time to absorb these units as the market goes up. You don't want to renovate too many units at once, and we never do that. We'll renovate 4, 5, 6, 7 units a month. We don't renovate more than that because now you're increasing rents and it takes time to absorb that. So this is a process. It takes time. They've gotten to the point where their investment thesis is met. They probably double their money, so they're leaving. And we are going to then start to renovate again to a higher spec granite countertops when we are leaving that meat in the bone for the next person.
Yeah, I mean, if you renovate everything and there's nothing left to renovate, your property is worth less to the next person. Your cap rate will be increased. It's not a value add. It's a stabilized asset. If I invest into the fund, will the returns from me be the same as people who invested previously in terms of cash flow and returns at exit?
Say that again.
If I invest into the fund now, will the returns I get be the same as investors who invested previously into the fund?
You do. So this particular fund does not have what is known as a true up. So the people that invested a year ago at the beginning of the fund and the people that are investing today get the same return. Yes.
Is diversification the main and only reason you personally prefer the fund investment route?
Yes, I also prefer it because the clock starts ticking the day that you give us money. Whereas with a individual property, your clock's going to start ticking when we finish the purchase. So you get, you gain about 2 or 3 months there.
I think this question was asked before. When do you estimate you will close on the property? In other words, when can we expect the clock to start ticking for us? March or April? Is there a double layer of fees when investing into the fund? Specifically, are there fees at the fund level?
No, that would be problematic.
There actually is a fee. There is
One fee.
an admin fee at the fund level, but no other fees. There's no acquisition or asset or anything. All of those are at the underlying level.
Yes, I want to point out that that fee is extraordinarily small compared to our other fees. So if you compare the big fees that we charge, and you're looking at this admin fee, it's a very small amount.
This person, I don't know, has already jumped into something. It says in the pro forma, the year one NOI is 1.795 mil and a purchase price of 29.6, giving me 6.1 cap. How do I get 6.8 cap? Well, Greg, that has to do likely with the adjusted property taxes and insurance.
Mm-hmm.
So we're talking the 6.8 is an adjusted cap rate.
Yes, and by the way, that is in the underwriting, so you'll be able to see those adjustments.
No, I think they've already
jumped.
They're already in the video, Neal.
Right.
They've already jumped into the video.
For ahead of us, it's like, wait a minute. I'm still looking at the video.
Okay, Neal, I think we are at time.
Yeah, well, thank you everyone for attending. Fantastic questions, amazing list of questions. And based on the poll, I think that we're going to do very well. So end March now looks more likely than April. So thank you everyone for your time, and we will see you on the next one. Bye-bye.
Bye-bye.